Last week, the stock market had a one-day rally. Yes, a one-day rally when the Fed announced a 50 basis point rate hike. The next day, sellers returned to carry out a demolition job. Stocks suffered the biggest one-day loss since the pandemic and extended their losing streak to 6 consecutive weeks. The S&P 500, as of today, is now down about 15%. The Dow is down about 11%, and the NASDAQ 100 is down about 25%. When big sell-offs make an appearance on Wall Street, debate about whether the market has bottomed isn't far behind. But the market still has not reached the puking out moment that usually precedes a market bottom and signals that it's safe for investors to return to the market. We are still in a downtrending market. What's worse is that bonds, all bonds, have been decimated at a time when they were supposed to provide a safe haven for investors. This includes government bonds, corporate bonds, high-yield bonds, etc. Hi, I'm Ben Rapond. Welcome to my YouTube presentation. Today is May 10, 2022. I'm going to feature 3 economists from different perspectives. They're all independent of Wall Street. They're independent. They don't work for big banks or brokerage firms, independent thinkers, and all have gotten it right in the past to some extent, one way or another, this time or that. But there's a lot of forecasting and predictions that can be attributed to both of them, or to all 3 of them, that are accurate. I'll introduce each one. The first one is David McAlvany. I follow David McAlvany on his weekly podcast. It's very interesting, very smart, and independent. I would call him an economist and a kind of a forward-thinking think tank person, and is asked to speak and make presentations all over the world. Very credible, and so I'll play his video at this point.
Joining me right now is David McAlvany of McAlvany Financial Companies. Thanks so much, David, for being with us. So what are your thoughts on the volatility we're seeing? I mean, that it's still somehow a winning week. I'm not even sure how that's possible because you feel like you've been tossed around here. What a week it's been.
Yeah, the futures, you had a lot of traders come in with futures lower this morning, and with a huge supply overhang of supply and securities, liquidation started fast and furious. I think the reality is people are lingering on this idea of inflation. Inflation is not going to be quickly resolved, and 50 basis points won't even begin to touch taming that particular beast. So bonds, even on a day where we see equities selling off, bonds are selling off at the same time. That's the big surprise, that there's no bid for the 10-year treasury. If you go back to 2008 and comparable kinds of sell-offs in the equities market, you would expect to see bonds stepping up the rotation towards a safe haven, and bonds are no safe haven today.
Yeah, and they're buying nothing. I mean, when you look around, and there's a lot of names that are down 10, 20%, some big moves, names like Etsy, Expedia, eBay, Moderna. I just saw Hanes Celestials down 17%. Sprouts Farmer Market. I mean, there's so many names, some very popular, some random. I get it, but they're just not biting on anything. It is red across the board. It is red on every sector. When do you think that this mentality will change? Because people were hoping for it to change in January, February, March, April, and now we're in May, and it still hasn't changed.
Yeah, I mean, if you go back to the first quarter of 2021, we began to see a deterioration technically in the IWM. So your Russell 2000, your small cap stocks began to give you sort of a leading edge indicator that something was not right in the equity space. What we've seen since then is that technical deterioration has spread to the S&P, it's spread to the QQQs, the NASDAQ 100, and the Dow is frankly one of the only strong-suited indices out there today, obviously not performing well today. But the technical deterioration suggests a long-term top is being put in. And a long-term top suggests that we're a long way off from this being done. If these levels don't hold, you could see a waterfall cascade decline from here. So really need to see a bounce. And if that doesn't come through in the next, a few percentage points on these major indices, I think you're looking at something that's with us for some time to come. It's a bear market.
Yeah.
It's a rip-roaring bear market.
Without a doubt.
And I think this is to appreciate what has been happening for the last 30 to 40 years. We've had massive growth in all asset classes as a result of cheap credit. And as long as the money is flowing, asset prices can increase in value. But when you begin to see a tightening of that liquidity, when you begin to see credit constrained, then these asset classes which have benefited so much, all of them are going to face retrenchment. So your companies that have zero revenue, all of a sudden you look at them differently. The bond market, which has been in a bull market for 40 years, we got to interest rates were 4,000-year lows. Where do we go from here? The inflation is the catalyst for change here, both in equities and bonds, ultimately as it plays through into real estate. And in inflation, although we may not see these near double-digit levels on a sustained basis, a new normal of, say, 5 to 7% is something the equity market has yet to digest as the way forward.
Right. And, as we look at all 30 names in the Dow Jones Industrial Average today, again, also no names shining. On the contrary, all 30 are in the red, and some are down 4, 5, 6, 7%. I mean, Salesforce, Nike, Apple, Home Depot, Microsoft are all down between 4 and almost 8%. So the pressure is on. At this time,
Nicole,
though, you are bullish on certain areas. I wanted to get to some of your picks so our viewers can use your ideas of real things: infrastructure, natural resources, precious metals. If you could tell us about some of your investment ideas and add the thought that you want to get in there.
Yeah, well, first on the currency market, we see this as a global decline, and you're seeing that in the emerging markets today. You're seeing the emerging market currencies. You've got the offshore yuan, which is trading lower, significantly lower today. And of course, the yen is as well. These are very significant things within the leveraged community to see changes within the currencies and volatility within the currency markets. So again, very unsettling to say the least. Where are we bullish? We're bullish on hard assets. We're bullish on real things that have cash flow. These, I think, will stand the test of time as an enduring inflation plays out. And so we like infrastructure. We like specialty real estate, although we've hedged some of that more recently, as there is an inflation component or an interest rate component to that. We like global natural resources very selectively, and we do like precious metals and the precious metals miners. We see gold being the safe haven that treasuries have been in previous cycles. And when treasuries all of a sudden are faced with an inflationary pressure, where do you go to opt out? To move to cash is to assume that you're going to have a negative real return of 5 to 7%. With whatever interest rate you're receiving, you're still in real terms negative 5 to 7%. So you go back to the 1980s, the Summers-Barsky thesis, the idea that gold outperforms in a period of underperformance with other asset classes. Where is the grass any greener? So I think you have a very significant story unfolding within the precious metal space. And then again, selectively within the commodity space, there's some which, if we do move into a global recession, if stagflation becomes something that we're dealing with on a longer term basis, there are industrial commodities which will suffer. So again, global natural resources is very selective. Infrastructure is also a play. We just want to own real things that you can stub your toe on, that have a cash flow attached to them, that we think investors will continue to be able to wrap their minds around.
Yeah, understood. Bullish on these hard assets, things that we really can see and feel and use. We appreciate it. David McIlvaney of McIlvaney Financial. Thank you so much. Nice to see you.
Thank you, Nicole.
So as McIlvaney points out, at this point, there are pretty much all sellers and very few buyers in the market. Next, I want to show an interview that Maria Bartiromo did with Professor Ken Rogoff I'll tell you a little bit about him. He is a distinguished professor of economics at Harvard and is former chief economist for the International Monetary Fund. He has a wonderful perspective on markets, both in the U.S. and around the world. So I will play this, and then you can observe what he says about the Federal Reserve, the way that the Federal Reserve has boxed themselves into the corner, that we're at a crossroads. Which way do they go? Massive inflation, letting inflation continue to go and hold off with the rate hikes, or slow them down, or go the other way and do aggressive rate hikes and tank the economy. Anything in the middle, it is thought, is probably going to do both. So they have to be aggressive, either in laying off rate hikes or aggressive with rate hikes, but the outcome is horrible in both cases.
Let's get some expert analysis here on this GDP number, which, of course, is a decline of 1.4% versus an estimate of a gain of 1.1%. Joining me right now is former chief economist at the IMF, Harvard University economics professor, Kenneth Rogoff. Ken, it's always a pleasure to see you. Give us your reaction to this GDP number this morning, down 1.4% on the first read.
Yeah, well, it's a preliminary number. I was expecting a low number, but it's shocking. I really don't want to say it's, even below the worst that I thought it might be. 8.5% inflation, more than minus 1% GDP growth, not a very good quarter.
Where do you think this goes from here, Ken, and what's going to save us? We spoke with Brian Moynihan on this program yesterday. The CEO of Bank of America talked about how strong the consumer is right now, Ken. And I know you are also studying this shift in spending. And even though the consumer has shifted spending from buying goods to spending money on things like travel and getting out and services, you're still seeing a growth story that is deteriorating.
Well, I think you said it exactly right. It's a growth story, but it's deteriorating. And the question is how far. The consumer has a lot of money saved up from stimulus checks and savings from the pandemic. But on the other hand, inflation is really high. The war is still going on. And I think the biggest unknown is this Fed tightening cycle. If they don't hike rates a lot, there's going to be inflation. And if they do, there's going to be a massive recession.
Well, we're expecting a rate hike next week in early May. We're expecting a 50 basis point hike. Is that going to be effective, and this string of rate hikes, in stamping out inflation, Ken?
Well, they've decided to go faster, but they really haven't decided to go far. And the markets still seem to believe that, they can raise them 3% and maybe everything will be fine, 2-3%. But I think they're going to have to go to 4 and 5% to stamp out inflation. Will they? They talk tough, but when the rubber hits the road and it really gets grim in the economy and the midterms coming up, I suspect, as I think I told you last time we spoke, they'll end up allowing inflation to stay elevated and we'll be in a low growth, high inflation story.
And finally, I want to present Jeremy Grantham. You may not know it. He may not be the household word, name that Warren Buffett is, but he is distinguished in the investment industry, extremely knowledgeable, master's degree from Harvard, and he is the co-founder of the firm Grantham, Mayo, and Van Otterloo in Boston, which manages $68 billion. He has a track record of predicting market crashes, and it is said actually calling market tops right before the market declines. So you'll see quite a bit of that, and I'm going to show you some clips in his interview with Eric Schatzker from Bloomberg. In this video, he says this: the 60-40 portfolio, the buy and hold portfolio, the traditional method that most investors have been subjected to by financial advisors, that 60-40 balanced portfolio is absolutely useless. When that is said by Jeremy Grantham, that carries a lot of weight. So I'll have you listen to this, and then I'll provide some comments and wrap up what I think all of these three mean to the average investor and what you can do about it.
I'm Eric Schatzker, and welcome to an encore edition of Bloomberg's Front Row. Jeremy Grantham has been investing for a half century and calling bubbles for almost as long. He's a living legend in financial markets. A year ago, Jeremy predicted the pandemic rally would end with a historic crash. Here's what he told me.
When you have reached this level of obvious super enthusiasm, the bubble has always, without exception, broken in the next few months, not a few years.
Jeremy says U.S. stocks are in a super bubble, only the fourth of the past century.
Super bubbles can really wipe you out, like 1929. And that's where we are now.
All the same, 2021 was a great year for stocks. If I'm not mistaken, the seventh best in a half century.
And this has been exactly how the great bubbles have broken. The blue chips, the S&P 500, have kept strong right up to the last second, and wave after wave of the stocks that had made the real running peel off and drop. In 1929, the flakes were down for the year before the market broke. They were down 30%. The year before, they'd been up 85. They had crushed the market. The really classic example of this is the Russell 2000, which is stock number 1,001 to 3,000. They're multi-billion-dollar companies. They're a serious enterprise. In the last year, they are down. They have not made any money at all. The S&P's made 23%. The Russell 2000 is meant to go up about 1.2 times the market. In a bull market like you're saying there was, it should have been up about 30%. It wasn't even up recently. This is a huge divergence of a kind that has never happened other than the super bubbles of 1929 and 2000. 2000, you may remember, the growth stocks peeled off and were down 50%. The S&P was flat, which meant the remaining 70% had risen 20%. This is an enormous divergence, and it happens on the upside.
The hallmark of a bubble is what you have termed crazy behavior. What would you point to today, right now, as further evidence of crazy behavior?
I think the crazy behavior, the peak of crazy behavior is behind us. I really do. I think we're now in the buy the dip mode, which the super bubbles specialize in. You don't have 2 years of buying frenzy dying overnight, typically. So even in 1929, you had some magnificent rallies. And buy the dip is the watchword of practically every brokerage house out there. And it always is. You never, almost never, have a major brokerage house say, the game's over, guys, duck. It doesn't happen. The commercial imperative is overwhelming to stay bullish. It's how you make money.
If you're right, and stocks are in a multi-sigma deviation from the statistical trend, tell me what happens. The S&P 500 peaked at almost 4,800 points. Where does it bottom?
The trend line, being slightly generous, is 2,500. And most of the great bubbles, the super bubbles, go below trend and stay there for quite a while. In the Greenspan era, that tendency stopped. In 2000, yes, the NASDAQ came down 82%, which was fairly brutal. Amazon came down 92. But the Federal Reserve raced to the rescue so loudly and strongly that they stopped the decline in the S&P at trend line. It only declined 50%. 50% is a hell of a big decline, but it was only enough to get it back then to trend. This time trend is at most 2,500. And I would expect, even if the Federal Reserve tries to do the same, it will be hard to prevent the market from declining to that level.
So we're talking about a decline of, certainly from the peak, of almost 50%.
Almost 50%. And of course, it declined very quickly, 50% in 1929. It declined 50% in 3 years in 2000. And the housing market, which was another great American super bubble, went all the way back to trend in 3 years.
What if I'm a long-term investor, say running a pension fund or managing my own 401k, which I should add, I don't. But what if I'm one of those people and I look at history and history tells me that over time, independent or including crashes, stocks deliver a handsome return. And if I just stay in the market, I'll get that return, whether it's 7% or 8% or 9% or 10% over time.
You know, if you could set your dial for 50 years and throw the key away, that might make some sense. But let me remind you that in 1929, you didn't get back in real terms until about 1954. That's a long wait. In 2000, you didn't get back for 13 years. By modern standards, that's a pretty long wait. And in Japan, which is really the granddaddy of both bubbles, land, and stocks, they are not back to their 1989 peak today. That is a very, very long wait. So if you think you can stand it for 10 or 20 or even 30 years, be my guest. But history says a lot of you will not stand it. A lot of you will become more conservative deep into this kind of correction. Super bubbles can really wipe you out like 1929 did. And that's where we are now. We entered a few months ago into 3 sigma territory, super bubble territory. And the other great risk is last year we also entered bubbles in real estate. So this is a very dangerous year that we've just had.
If bonds are overpriced and stocks are overpriced, does that make the traditional 60-40 balanced portfolio useless?
Absolutely useless. There's a lot about this economy, I think, that will be dragged back into the late 20th century. We've had a very, very abnormal honeymoon Goldilocks period for 20 years, which I think is ending. Let me put it this way. We're in the early stages of running out of raw materials. Of course, we live on a finite planet. There's only a certain amount of cheap oil, cheap nickel, cheap copper, and we're beginning to hit some of those boundaries. And we're going to have bottlenecks here, there, and everywhere. The food price index of the UN is about as high as it gets. Growing food is not getting easier. Climate change is coming with heavy floods, serious droughts, and higher temperatures. None of these make farming easier. So we're going to live in a world of bottlenecks and shortages and price spikes, and we have to get used to it and learn to manage our way around it. Looking out into the future, it is pretty clear that we are running out of labor. Fertility rates have dropped like a stone. China is reeling from the shock of finding that it has 10.8 million babies last year. It's only the other year, 7 or 8 years ago, it had 20. And this means absolute certainty that the cohorts of 20-year-olds coming into the workforce will be smaller going forward. Everywhere in the developed world, we're below replacement in fertility.
The Federal Reserve is confident that it can contain inflation with a series of incremental rate hikes. What do you think it'll take?
I think the Fed absolutely does not get the pain that's involved with a bubble breaking. You can see that in the history of the last 50 years. Greenspan encouraged the tech bubble. He bragged about the productivity gains from the internet that would last forever. Actually, productivity has declined slowly but surely since then. When it broke, it caused a lot of pain. Bernanke learned nothing. He encouraged the housing bubble. He denied its existence, even though it was a 3 sigma, 1 in a 100-year event that had never occurred in American history before. And what have we learned? We just went straight back into the game, overstimulating, pushing the rates down and down they have gone for 50 years. So they started at 16% on the long bond, and now the real return you would get is -2.
Okay, so you've heard from David McAlvany, Ken Rogoff, and Jeremy Grantham, all from very different perspectives and all in a way saying the same thing. The Fed has to raise interest rates, and they actually have to raise them aggressively. I think Ken Rogoff said that the target of 2 to 3%, getting to that target of rates, is not going to be enough. They're going to have to go to 4% or 5%. This is going to absolutely, if they follow that, which they probably will have to, if they do, it will destroy the economy, it will destroy the bond market, and destroy the stock market. I mean, a deep, deep decline is in our future, and I think one of them said it is probably going to go down about 50%. The S&P is only down about 15% now, and yet bonds have already started, and stocks have started their collapse. So we don't know the future. We can't anticipate completely what the Fed is going to do, but because they are so boxed in the corner, they have no room to move except to raise interest rates or let inflation go out of control. Either way they go, it is a very bad scenario. I believe they are committed, have always been committed to reining in inflation, which they can do with interest rate hikes. But the repercussions at this point to the economy are disastrous. And to the average investor who is following the advice of the investment industry, the financial advisors who have put them in stocks and bonds or stock funds and bond funds, those are coming down fast. And I don't know each person, obviously, and each person is different. Each person's goals are different. Their investment choices are different. But I would invite you to do this. If you haven't done this, go take a look at your portfolio. Look at it. December 31, the end of last year, and so far this year, how far down has it come? Are you okay with that? Are you prepared for that? And they say typically you just have to invest for the long run. You have to endure the ups and downs. You can't sell now. These kinds of sound bites. And yet normally bonds are there to counteract stocks. That is not the case. The long-term government bond has dropped much more than the S&P 500. There is no protection being provided. And so when you come back to it, okay, what can you do? So I put this slide together. I showed it last week. I'm going to show it again because I think it's very relevant. I always want to say, what can you do? And I did add one item, which I forgot to add last week, so I'll cover it. What can you do? Stay away from buy and hold investing. 2, don't buy real estate now. There will come a time, right now, prices are too elevated. Secure your income, whatever that means to you. Number 4, this is what I added. Buy some gold or silver. If you own some and you want to own some more, go ahead and do that. If you have a little sleeve, a little container of 20 ounces of silver, the cost today is about the cheapest price I could find, retail price I could find was $27 per ounce. For 20 ounces, that's about $540. So if you don't own some, start to accumulate those, buy them. As many of those as you can, maybe once a month, add some more, as much as you can afford. If you have as much as you want, good, hang on to it. that is not an investment, that is an insurance policy against the declining value of the dollar, which we're now experiencing. Watch out for your emotions. Don't buy what the media is selling. Be wary of who you think you can trust. Enjoy your relationships. They are precious and they're valuable. If you have a portfolio and you are not getting satisfaction from your financial advisor and you want someone to talk to bounce ideas off of, to check out your thoughts, feel free to give me a call. I'd be glad to talk with you. And if you decide to do business with us, there's 3 things that I would do. I would first of all put your money in cash, stop the bleeding. Number 2, have you fill out a risk tolerance questionnaire. And I know you filled them out in the past, but I pay attention to it. When you say I'm willing to take this much risk, I take it seriously. And thirdly, I would design a portfolio that is designed to get you back to where you started correctly and without bonds. So I would welcome your call if you want to chat. Otherwise, these are some things that you can do. And finally, the Fed is, shall we say, flying with a blindfold on. They don't know what they're doing. They should have done something much earlier. They should have, even this year, raised rates even more. And now the further they keep kicking the can down the road, delaying the inevitable, the more aggressive they're going to have to be and the more they're going to tank the economy. I see no alternative unless, I don't know, there just isn't an alternative. The only alternative is to put up with hyperinflation, and I don't see that as an option. If you have comments or questions, feel free to leave them in the comment section below. There's my name and phone number, email address. Feel free to contact me if you want to talk. Thank you again for watching.